Index funds or ETFs? Which one's better for you? If you've ever Googled how to start investing, you've probably seen both of these thrown around as the smart choice for beginners. But here's the thing. While they look almost identical on the surface, they have some small differences that can make a huge difference in the long run. So today, we're going to break down exactly what they are, their similarities, their differences, and finally, which one might actually be the better fit for your portfolio. If you're new here, do me a quick favor and hit that subscribe button right now. It costs you nothing, but it helps us keep bringing you content that could change your financial life forever. And just a quick disclaimer before we dive in, this is for educational purposes only and is not financial advice. Always do your own research. All right, let's start with index funds. Imagine you want to invest in the stock market, but you have no idea which companies to pick. Should you buy Apple? Maybe Tesla? Or play it safe with a company like Coca-Cola? The problem is, nobody really knows which single stock will perform the best. That's where index funds come in. An index fund is like a giant basket that holds a bunch of different stocks, all designed to track a specific market index. For example, an S&P 500 index fund owns shares of all 500 of the biggest U.S. companies, from Apple and Microsoft all the way down to McDonald's and Walmart. So, when you buy just one share of that index fund, you instantly own a tiny piece of all those companies. You don't have to worry about guessing which one will win. If the overall market goes up, your investment goes up with it. It's diversification made simple. And because index funds are not run by expensive managers trying to beat the market, they're just copying it, the fees are super low. These funds are passively managed. Most index funds charge an annual fee, called an expense ratio, of anywhere from 0.02% to 0.20%. To put that into perspective, if you invest $1,000, you might pay just 20 cents to $2 per year in fees. That's incredibly cheap compared to traditional mutual funds. Now, one key thing to know about index funds is that they are priced only once per day. At the end of each trading day, the fund calculates its net asset value, or NAV, which is the total value of all the stocks inside it, divided by the number of shares. No matter when you place your order during the day, you'll get that single end-of-day price. Another interesting aspect of index funds is how they are treated for tax purposes in some countries. For example, in certain places like Spain, regulations allow you to switch from one index fund to another, say from an S&P 500 fund to an international stocks fund, without it being a taxable event. This means you don't have to immediately pay capital gains taxes just for reallocating your investments, which can be a powerful advantage for long-term growth. However, this isn't a universal benefit. In the U.S., for instance, selling one fund to buy another is a taxable event, so you'd likely owe capital gains taxes. It really depends on the tax rules where you live, so be sure to check that out. What's your take on this? Let me know in the comments below. Index funds are typically offered by major providers like Vanguard, Fidelity, or BlackRock. Each company has its own policies, but the core principle remains the same. Trades are processed once a day at the closing price. Okay, now that we've covered index funds, let's talk about ETFs, or exchange-traded funds. On the surface, they can look very, very similar. You get exposure to hundreds of stocks or bonds in one single investment, just like an index fund. An S&P 500 ETF, for example, also holds shares of those 500 big U.S. companies, giving you instant diversification. But here's where ETFs really stand out. They trade on stock exchanges, just like individual stocks. This means you can buy or sell them at any time during market hours, and their price changes constantly throughout the day based on supply and demand. Compare that to index funds, which only get priced once a day, and you can see how ETFs give investors more flexibility and control over when they enter or exit a position. ETFs are also relatively new compared to index funds. The very first ETF in the U.S., the SPDR S&P 500, with the ticker symbol SPY, launched back in 1993. It's still one of the largest in the world today. Since then, ETFs have exploded in popularity, not just in the US, but globally, because they offer that perfect blend of diversification and trading convenience. And here's another twist. While most ETFs are passively managed, meaning they just track an index like the S&P 500 or the NASDAQ, there are also actively managed ETFs. These are funds where professional managers are actively trying to beat the market by hand-picking investments. Some investors are drawn to these because they allow you to bet on specific ideas or sectors. To make this more concrete, let's pull up a fact sheet for a popular ETF, VOO, the Vanguard S&P 500 ETF. Right away, it clearly states that it tracks the S&P 500, confirming it's passively managed. You'll also see details like the number of holdings and the replication method. You might see a term like full replication, which means the ETF owns nearly all the stocks in the index. That's a good sign you're truly getting the whole market basket. Next, look at the expense ratio. As we can see here, it's only about 0.03%. That's one of the cheapest investment products you'll ever find, period. Another thing to check is dividends. VOO, for example, is a distributing ETF, which means it pays out cash dividends to investors, usually every quarter. Some ETFs work a bit differently and are called accumulating ETFs. Instead of paying you the dividends in cash, they automatically reinvest them back into the fund for you. This can be great for compounding your returns over the long term. If you're interested in learning more about accumulating ETFs, I strongly recommend watching the video I've linked in the description. Finally, let's look at the top holdings and their weights. You'll usually see familiar names at the top, like Apple, Microsoft, or Amazon. Remember, these can change a bit as the market moves, since the holdings are ranked by market capitalization. The biggest companies naturally take up the largest share of the fund. Now, before we wrap up, let's clear up some common misconceptions about both index funds and ETFs. First, just because something is an ETF doesn't automatically make it better than an index fund. Yes, ETFs trade like stocks, but that flexibility isn't always useful, especially if you're a buy-and-hold long-term investor. In fact, it can sometimes tempt you to trade more often than you should. Second, actively managed ETFs do not guarantee higher returns. In reality, picking a manager who can consistently beat the market is incredibly difficult. According to data from Morningstar, only about 3 out of every 10 active funds actually manage to outperform the market over the long run. And finally, a lot of people think ETFs are risk-free just because they're diversified. But here's the truth. An ETF is only as safe as what's inside it. If it's tracking something volatile like a niche tech sector or crypto-related assets, it can jump up and down just as much as individual stocks. Diversification helps, but it doesn't eliminate risk. So, which one is right for you? Honestly, it really depends on your country's tax laws and your personal investing style. The key takeaway is to invest in the market with low-cost funds and focus on long-term growth. Both index funds and ETFs are fantastic tools to help you do that. If you found this video helpful, please consider subscribing and smashing that like button to help grow this community. And if you like this video, you'll probably enjoy this one right here as well. Thanks for watching, and I'll see you very soon.